and welcome back to our channel. Today I have Teresa Kong from Methods Asia with me. Teresa is a senior portfolio manager and the head of fixed income of Methods Asia. Welcome, Teresa.
Thank you.
Teresa, we have seen a lot of movements in the Asian fixed income market, especially since the outbreak of coronavirus pandemic. So can you please describe for us what happened since the outbreak in January?
So, maybe just rewinding back to, the beginning of the year, I think we've gone through many stages with respect to the coronavirus and the crisis. Most recently, I would say that we've really moved away from the dash for cash, which really characterized by the end of March, to now much more of a response whereby the markets really believe that the policymakers' response may actually be relatively sufficient to combat COVID-19. And as a result, we've seen actually quite a nice rebound in prices. Now, having said that, we do expect this to cycle through, i.e., while we believe we have reached bottom in March, we do expect periods of volatility till we find an actual vaccine or treatment.
How have the flows into Asian high yield developed since the start of the year?
The flows out of high yield has been relatively violent. What we have seen has been some differentiation amongst different countries' bonds. So for example, China still has a core set of investors that are high net worth with Singaporean or Hong Kong accounts. And when prices actually go down, we do see buyers coming in and demand for these Chinese bonds, especially in sectors like real estate, where you have a lot of blue chip companies with very well-known brands. Countries that really have not had this core investor base have been, countries like Indonesia, where we really have not seen a lot of buying or value investors coming and saying, yeah, things may be overdone. Let's start buying the bonds. So by and large, I do think that flows have started to come back because value investors are attracted to the yields and do see this once in a decade opportunity. However, there's no doubt that there's been relatively large outflows, and it's been quite differentiated amongst the countries depending on whether there's a core base that's available and has the dry powder to deploy.
Spreads for Asian high yields have dramatically widened during the last couple of months. What does this tell us?
As we speak in the middle of May, high yield spreads are hovering around 825 basis points above US Treasuries. Now, if you put that in historical perspective, that means that if you had bought Asia high yield at these levels and had held it for 1, 2, 3 years, you historically would have never lost money. Now, having said that, we know that Treasuries are at historical lows. And so even if you haircut it by, let's say, 2 to 4 percentage points, your returns would still have been definitely in the high single digits to very well in the double digits over the next 2-3 years.
What changes in your portfolios did you make since the outbreak of the coronavirus pandemic?
So if you think about, our exposures, we're always exposed to some combination of credit, currencies, and rates. And first, maybe speaking just largely to credit, the major change that we've made has been our reducing our exposure to Sri Lanka. Sri Lanka as a sovereign, even previous to the crisis, has suffered from a downturn in tourism. As you recall, there was a bombing of the Four Seasons back a couple of years ago. And as a result, the country has always depended on tourism, and we had expected a nice rebound this year. But because of COVID-19, it's quite clear that the fiscal deficit is going to be much greater than we had expected. In addition, their current account is also going to be vulnerable because of the lack of tourism bringing in foreign exchange. And we've already seen the government really implement what I would consider to be quite draconian measures to save their FX. So for example, unless you're importing essential goods such as oil or medical equipment, the country has said no more imports. And so it really points to a country that is going to potentially suffer from debt sustainability. So that's one country where we've cut back exposure. In terms of other exposures, in terms of currencies and rates, We've cut back our exposure in Indian rupee because that country, we think, also has relatively weaker infrastructure. And we don't think that back when we sold Indian rupee exposure, that it was sufficiently pricing in the risk of further sell-off. And lastly, we have increased our exposure to interest rates. We think that global central banks will continue to try to step on the gas pedal and make their country whole by lowering rates. And as a result, we think that's going to be a relatively safe bet for the near term.
So what about Thailand? They are also heavily relying on tourism, and we know that they are running into economic problems. What's your opinion about Thailand?
Well, as you pointed out, Thailand is very dependent on tourism. However, the country is on relatively better footing than some of the other countries that are dependent on tourism, like smaller ones, like I said, like Sri Lanka, the Maldives, which they're much smaller in nature, and so we think that Thailand is actually going to come out of this fine over the long run. Having said that, most of our exposure in Thailand are in interest rates. We think that interest rates will continue to be low, both for structural reasons because of the demographics. Thailand has actually one of the fastest aging populations in the world, and we think that interest rates actually have more room to come down. So that's actually the majority of our exposure in Thailand is through interest rate exposure.
How about the maturity and the quality of the bonds in your portfolio? What changes did you make since the outbreak?
So in terms of the quality in our portfolio, we have been able to upgrade our portfolio somewhat. We've seen a lot of really good opportunities in the sector called fallen angels, as well as companies that are on the cusp of investment grade. The demand for sub-investment grade bonds or high yield bonds is about a fifth of that of investment grade. So typically when there's worries around whether or not a company would actually be defaulted, there tends to be selling before the actual fact. And as a result, we are seeing our ability to actually pick up these bonds at relatively good yields. In addition to that, Asia bonds are also indirectly benefiting from the Fed buying program that have been announced. Even though that hasn't really been carried out to a large extent, even the signaling has really provided a bottom to the triple B/double B sector. With respect to your question about maturities, we've actually experienced an extension of maturities in our portfolio, which is really just due to the nature of high yield. So one of the things about high yield is that the bonds have an embedded call option, whereby the borrower has ability to call back the bonds when rates actually come down. But as spreads have widened out so much, it no longer behooves the borrower to be calling back the bonds. So instead of the market expecting the bonds to be called, let's say in a year or two, the market is actually expecting the bonds to actually mature. So think of it as a mortgage, right? When mortgage rates come down, everyone expects you to refinance, and so the expected maturity of your mortgage comes down. But when interest rates go up very drastically, you're not going to be refinancing your mortgage. And that's exactly what we experienced in our portfolio because of the very sudden widening in spreads. So without actually having done anything, the overall maturity of our portfolio has actually lengthened. And on the contrary, as we expect the markets to recover, we do expect the maturities also then to also shorten as a result. So we will actually see a price improvement, not only from the credit spread compression, but also from the reversal of this extension risk that we experience on the way up.
Every crisis is creating new opportunities. So where are the opportunities resulting from the coronavirus pandemic?
Overall, our biggest exposure across all of our portfolios has been in China real estate. We have added a little bit more exposure to China, but we don't go over 50% because we don't think that's prudent. But we do have substantial percentage in China, and about half of that exposure is in China real estate. There's obviously a lot of headlines and caution around China real estate, but the reality is that it actually is a very strong sector due to three key reasons. First, urbanization continues in China at the pace of approximately adding one new Los Angeles per year. So we're talking about 5 million people moving into the cities, and that's not going to stop. Secondly, culturally is very important by buying a house in order to start a family. And last but not least, real estate continues to be one of the real few investments that the Chinese onshore can actually be investing in because of the relatively lack of depth in the bond markets and equity markets. And so the tailwind is very much behind China real estate. And we think that a lot of this this caution and a lot of the worries surrounding the debt is definitely true for some portion of the real estate market in China. But by and large, if you're going with an active manager like ourselves, which have a lot of local knowledge and we handpick the bonds, we actually think that this sector offers a lot of really great opportunities right now.
So what do you think will be the long-term effect of the coronavirus pandemic on the Asian fixed income landscape?
You know, that's the elephant in the room. I think it's clear that there will be winners and losers. And then there are some industries that it's not clear whether this is noise, temporary or persistent. Well, let's start with the winners. I think that the COVID-19 has definitely catalyzed what we are calling the Amazonification, right, of retail. And we've definitely seen migration towards the online space and the virtual space. And we think that that's just going to continue. So the trajectory and growth for that space is going to continue very positively. In terms of the industries where, you know, we're somewhat more worried, I think that we are somewhat more worried about the industries such as commodities, which, you know, as you know, has been connected also with the recent fall in oil prices. And so some of the commodities, you know, may actually stay lower for longer, given the revision in global growth. So while we don't think that we own any stranded assets that are not going to be worth anything, we do think that a lot of commodity prices will probably stay lower for longer. And then finally, I think the big question mark are around industries like tourism and even things like gaming. You know, while in the near term, it'll be very difficult to see casinos being crowded again, we do think that, you know, over the course of 2 or 3 years from now, once we do have treatment or vaccine, no doubt people will be coming back. But in the meantime, I think it will be more prudent to watch to see whether or not this sector will continue to be as strong as it used to be.
So you already answered partly my next question. So where are the opportunities opening up in this crisis? So you named some of it. So the platform industry, stocks like Tencent, Alibaba, and so on. Are there other winners?
I think the big thing to keep in mind is that, you know, this is really the opportunity of a decade, you know, to be buying Asia high yield. And the reason I say that, you know, it goes back to my point about the returns that you're locking in. But also importantly, I think one really has to remember that the current prices are already impounding a huge rise in default rates. So, you know, a lot of people are worried about defaults, and they should be. So currently defaults are just hovering above 2%. But the market at 825 basis points above treasuries is actually impounding low teens default. And if you go back to the global financial crisis, the default rates back then was about 14% for Asia high yield. So it's already impounding a substantial amount of default. And so I think for most investors, keeping in mind the long term, being able to lock in yields today at high single digits and low double digits is really a great opportunity.
So what's your prediction for the default rates in the Asian high yield sector?
We are not really in the business of predicting. What we do is we look at the probabilities that's impounded in the current security prices, right? And we say, based on these prices, how can we back solve into what market expectations are and whether or not we differ from those market expectations? And currently, especially for the double B sector, where, you know, historically default rates have not been as high as for the single Bs or triple Cs, we do think that the market's already impounded a sufficient amount of defaults. So in other words, we don't think that Asian high yield default rates will breach 14% that was reached in the global financial crisis. It'll fall somewhere below that.
This was Teresa Kong from Matthews Asia. Thank you very much for being here with us today and sharing your insights, Teresa.